tell you, I really think that the industries of real estate and lending is short on great new ideas, and we've got a glut of the status quo. It's time to change that, because if you haven't noticed, things are changing around you. You need to rethink things, and I mean that. You really do. Tomorrow, a webinar with Angel Oak, rethinking your business. I don't care what you do or how great you think you are, or maybe you want the ideas. I'm telling you, you need to listen to what these guys have to say. Check it out. It's free. What do you have to lose? Rethink your business with Angel Oak tomorrow. Click this banner right over there, or find it somewhere around here. Real life examples of buyers and sellers getting screwed, how you can get caught up in it, and how we can fix it. Take one, cut. But first, I need to sell you something. I'm gonna sell you on yourself. Here's the deal. Quit going to webinars and seminars if you're not going to actually do the crap that you're learning. You see, the strategies that you learn and the technology that you use has to be the first thing you do every day, not the thing you get around to at the end of the day, because we all know that never happens. There you go. Okay, so General Electric is going to pay $1.5 billion in fines. You know, the people who make your refrigerator, but not for your refrigerator. They are today, in 2019, going to pay $1.5 billion, the fridge company. Like now, for subprime loans, one of their subsidiaries wrote back in 2005 to 2007. They're paying today for loans they wrote 19 years ago. That's the story right there. Forget all the details. That's the story. It's a non-mortgage company who bought something of a mortgage company that had subprime loans that they wrote 19 years ago. They're paying today. That's the story. Why, you might ask? Well, because one thing that we've learned from the Big Bang meltdown of years ago is that in the mortgage industry, there is no statute of limitations on your activities. Now, you might think there is, but there's not. We just saw that 19 years ago. Not a mortgage company, General Electric. So what you do today, you right now, even if it's okay by today's standards, might not be okay by tomorrow's standards. In fact, if we have anything resembling a meltdown, you can bank on it. Your activities today are going to get scrutinized. You remember, subprime loans were once considered just super, super awesome. I mean, they were considered great. Don't know that today, do you? See, because subprime loans came about to help the United States fulfill its low and moderate income housing goals through a whole bunch of administrations leading up to the meltdown. Subprime loans came about to help underserved communities like the African American communities and the Hispanic communities to have access to home ownership. That was the idea. Communities that have historically had lower credit scores and could not qualify for prime loans, well, we created this thing called a subprime loan, and it was positive. And then companies like GE bought these subprime loan companies and started offering them. And now today, GE is paying $1.5 billion for those once positive subprime loans. Subprime loans, you see, they were at one point, like I said, considered good. It's just amazing how quickly we forget these things. So the point is here, guys, your actions today can be scrutinized by tomorrow's standards. And I just showed you proof of that. Now, I also told you that any housing crisis that may crop up in the future will not come from our loans. We could pretty much see that, right? But I also told you that it could quite possibly happen from how we sell real estate. Now, with how we sell real estate, with what I deem to be flat out usury from these tech-based iBuyer non-real estate firms. Companies that lowball offers to unsophisticated, unsuspecting homeowners. You know, companies that I believe are looking for unsophisticated, unsuspecting homeowners. Companies like OfferPad and Opendoor. Companies that charge more money. Yes, they charge flat out more money than traditional real estate companies. Now, to prove my point, I want to show you an offer that was just sent to me from a Vegas real estate agent. An offer from Opendoor. Please look at this, and I need you to understand this, and I need you to get this message out to people who own homes or aspire to own homes. People who might one day sell homes. Check this thing out. Now you notice here, sales price, $334,000. This, like I said, is real and it's happening like right now. Opendoor's service fee on this $334,000 house is $35,070. That's over 10%. 10% would just be $34,400. This one's $35,070. Let that one sink in. Seriously, let that sink in. A real estate firm charging 6%. What are we getting over here? Not 1, not 2, not 3, not 4. We're not gonna freeze at 5. We're not gonna stay at 6. Over 10%. Now, Opendoor says, and I want you guys to understand this, it's not all of Opendoor's money. Please note that Opendoor's service charge is inclusive of the buyer's agent co-broker of $8,350, as well as seller concessions for operational costs in the amount of $26,720. And it says here, you notice, it says learn more below. So let's look below and see how clearly Opendoor spells this out for all of these sophisticated sellers. Remember, this is an actual offer. You see here where it says the seller's agent's commission, and then in parentheses, see how it breaks it down? From your listing agreement, paid by your seller. It's got repair requests, in parentheses, to be confirmed post-assessment. That's a great breakdown. Seller's closing costs, provided by, I guess, you. Loan payoff, I guess, provided by you. Net to seller at closing, net offer, less above fields. The above fields don't really spell anything out, do they? I mean, does this clear it up for you? Sure does for me. Did you notice that they called it the agent's commission? The agent charges a commission. Opendoor, they're charging service fees. I mean, seriously, how are they different? Well, here's the answer. They're not different. The use of the term commission, you see, has a negative connotation. Just look at the lawsuit real estate agents are going through right now. This is an attack on your industry. Everybody accepts the term service charge because, it sounds nicer. The term service charge doesn't leave a nasty taste in your mouth like commission does. 10%. That breaks down as Opendoor's charging 7.5%, I'd presume, more than any traditional real estate transaction, like seriously, ever, plus the use of a real estate agent, plus all the add-ons. And it all comes out to over 10%. Who in the hell is this going to appeal to? Ask yourself that. Who in the hell is this offer going to appeal to? Well, I'll tell you right now. Desperate homeowners looking to get out of their house. People who need to move, like right now. So what do we do when people need to move right now and they're desperate? Pretty simple, isn't it? We take advantage of these desperate people. That's what's happening. Like what pawn shops do in Vegas. And I'm telling you guys, the real estate and lending community, we need to do better than this. We need to self-police. We need to expose usury when we see it. Because in this instance, what I'm telling you is that if your legislators get a hold of this down the road, I would think they're going to completely blast Opendoor for usury. But the taste the taste left in the mouth of home buyers and sellers in our communities is going to be this. Just another example of how the real estate industry is screwing everybody over, even though nobody, or very few, in our real estate and lending community see companies like Opendoor as part of us. Yet your agents and lenders will be the ones left bearing the scarlet letter tomorrow for the actions of today's usury. So lenders and real estate agents alike, I need you to understand this. If you have a chance to profit from or benefit from working with any of these type of companies, you need to not do it. One, because I believe it hoses your clients over. Remember, over 10%. My God. Number two, if and when this really comes to light, it gets exposed for what it is, like it did with the subprime loans that were once considered good, then you as a real estate agent or a lender might get caught up in this litigious affair, or at minimum, you aid in tarnishing the reputations of future real estate agents and lenders alike. We saw this before with subprime loans. A good reputation gone bad affects the market. Your reputation pays the price. Not to mention, we screwed over a whole bunch of people who bought homes, didn't we? Today, a good reputation. Why? Because these iBuyer companies are assuming that your sellers are going to make a positive connection between the ease of use of buying a pair of shoes on Amazon and selling their house. They're going to take advantage of that connection, the reputation that technology is going to make things simpler, faster, and most importantly, cheaper. In this case, it's not. It's making it more expensive. And when this comes to light, and if our legislators get a hold of these companies down the road and you're caught up in the mix, you hurt everyone, as we saw before. How you fight back against this is you educate people who are buying houses, aspire to own houses, and actually do own homes who may one day sell those houses. We need to expose this type of usury and how we, as a real estate and lending community, are different from it. A very easy thing you can do is simply forward this show to anybody you know who's thinking of buying or selling a house. and steer clear of these iBuyer companies because they might be dressed up to look pretty, efficient, and inexpensive, but they are in fact not. They are downright more expensive than using a traditional real estate agent. Don't let that message get lost.